here's where the book that we put out, I think, is so helpful. When people learn pattern recognition and see it repeats over and over again, both favorable patterns and unfavorable patterns, the game becomes so much more obvious. And this is why you have to blot out all of the news that you hear, all of the worries from Washington, and just focus on the charts. When you look at this chart, again, using that word quote unquote perspective, look at what it looks like. It looks like, are you kidding me? Not only are we identifying a top, but if we close below that 104, which I think is eventually going to happen, it looks like gangbusters below. Look out below, and you're not going to come all the way down. But if you even make a 50% retracement of that wonderful move, a lot of people are going to get hurt big time. People say to me so many times, Stan, you wrote that book back in 1988. Does it still work? And it does, because the reality is, well, the game is obviously being played a whole lot faster than in the old days, which I wish we were still in. But the reality is supply and demand never changes. It's always supply and demand. And emotionally, fear and greed never changes. You have to learn first to be totally objective. You have to learn to put your emotions on the side and to really I don't want to be mystical, but let the charts talk to you instead of deciding, oh, I think this is going to happen, that's going to happen. At any point, just look, what are the probabilities? And if you don't have a strong probability, just go on to the next chart. This is what the game is all about. We always measure risk versus reward. Oversold is only a potential. It's kind of like gas filling up in a room, but to really get an explosion, you need somebody to light a match. So the match is, once you say, okay, I'm in this area, I didn't know which exact day it was going to start, but I knew the potential was there. And then as soon as you got reversal action in the market, move sharply up on that day, you could say okay, the probabilities are very strong that a match has just been lit. And happily, we were right for 2 weeks. And I think that the ABC rally that we look for, I think the C wave ended this morning.
All right, welcome back, everybody, to the TraderLion podcast. I'm your host, Richard Moglen. This is brought to you by the Ultimate Trading Guide. It's my pleasure to introduce our guest, the illustrious Stan Weinstein, obviously the author of Secrets for Profiting in Bull and Bear Markets. You can see my copy right behind me right there. Fantastic education and resource there. He's also the founder of Global Trend Alert, which you can access throughout TraderLion.com to hear his thoughts on a daily basis. I review it every single day, and it's definitely great to confirm what I'm already looking for, and then also a lot more stuff that I wasn't even looking at in terms of what's going on in the markets. We also recently released the Stage Analysis Model Book, which covers the prior year and covers many of the great performing stocks from last year with annotated charts where you can hear Stan's thoughts, what exactly he was picking up on in terms of early entries, buy points, as well as, and this is critical, proper sell techniques as well. So you can pick up your copy down below, and we actually have a surprise for people watching. For 3 of you down below, if you comment and explain your rationale for what stage Nvidia is currently in, we're going to select 3 of you to win a signed copy of the Stage Analysis Model Book. So if you want to win that from Stan, definitely go ahead and drop your comment down below. Again, just answer the question, what stage is Nvidia in? And then you have to give a good answer and reasoning behind that. So Stan, with all that said, thank you so much for joining us today. Always a pleasure to get to chat with you, and I always learn something new every single time. So thanks again for your time. Great to have you.
Rich, it's my pleasure. And again, timing is everything. I think we couldn't be doing this at a more timely point in the cycle. We started, first of all, long-term, from reading me, I feel that you're in a bear market. But I hate to get hung up on semantics, because then people think everything is negative. We're going to go show them that it isn't. That I kid around and say it's not an A to Z bear market. It's more like kidding around A to S. Yep. But there are a lot of stocks there that are big problems, and then we can isolate some good ones. But the reason I feel this is so timely, we're talking now on Wednesday night, is because on March 13th, we hit a really good oversold bottom. Even within a bear market should have good rallies. And we now, I think, and I can only give you the probabilities, I think the probability is very strong that this morning, on Wednesday morning, you ended the move up off of that oversold bottom. I said at the time when we caught it happily right at the bottom there that it was going to most likely be an ABC move. And I think we've now had the ABC. Our target had the minimum had been 495 roughly, which was the 200-day moving average for the Qs, which happily you put up there on the screen. And the point that I made in the Tuesday night daily update was, hey, if we don't soon close above that 495 level, which wouldn't have changed the long-term outlook, but would have extended this rally, we're going to be in trouble. And then I purposely on Tuesday night gave them some danger level. So I said it was like an A-B thing, where A, if you didn't get above the 495, and then B, if you broke below 489, was going to be a 1-2 negative punch. It happened this morning, and I think that was the end. I can only give you probabilities, but I feel very strongly that was the end of the 2-week rally. And it's really important for those traders who played the oversold rally, because in that kind of a bear market rally, you know your stuff, Rich, the stuff that goes up the best are the temporarily oversold stage 4 stocks. And that happened here. And this morning, I think game, set, match, it's over.
Perfect. And we're going to go through a lot of charts today. You picked out some favorable issues to talk about, also some unfavorable ones. We're going to cover a lot of semiconductor names as well as some leading groups and leading themes right now. But first things first, Stan, I want to kind of back us up just a little bit because I know you had some thoughts and wanted to share kind of what you were watching up in this area. To potentially, be on guard for what could happen next. Obviously, we never know what's going to happen next. We want to listen to the tape every single day, but there were some clear signs that you were watching carefully and noting in Global Trend Alert about, just to be a little bit more defensive and definitely selective, of course, in this area. So I'm very interested to hear kind of what you were watching right in this area.
Right. Well, so many traders and investors make the game harder than it has to be. Now, no, only the wise guys are always right, but you can always see what the good probabilities are. And as we moved up into that new all-time high that you just pointed out, it was a very, very narrow rally. It was led by the Magnificent Seven. And I've seen this movie so many times before, and the last reel isn't a good one. It happened back in January of 2022, where we also went to a new high, but it was again very narrow. And we know what happened thereafter. You had a 9-10 month bear market. It happened even more intensely way back when I go into my mind's eye, back in 1973, in the days of the Nifty 50, where the Dow actually topped out in early January of 73, but a lot of the Avons, Polaroid, Xeroxes for that day went up into the May-June period, and people thought, hey, the market's okay, but it wasn't okay because the rally got more and more narrow. And what happened here happened back in 73. In 73, while the Dow topped out in early January, the advanced decline line, the New York advanced decline line, actually topped out in March of 72, way before that. And it gave you a big head start that it was narrowing down. Same thing happened here. You take a look and you see the New York daily advanced decline line topped out, if memory serves me right, I think it was November 29th of 2024, and you made several new highs in the averages, but the AD refused to confirm. So the game really never changes. And people say to me so many times, Stan, you wrote that book back in 1988. Does it still work? And it does, because the reality is, well, the game is obviously being played a whole lot faster than in the old days, which I wish we were still in. But the reality is supply and demand never changes. It's always supply and demand. And emotionally, fear and greed never changes. When it's going down, they're worried to go to zero. It's going up forever. So it never, never alters. And that brings me up to another point that we made. When this high was made, our speculation index moved up to its highest level. This was a bell ringer since September of 1973. Speculation index went up over 900%. Again, the game never changes, so there were a lot of things.
Yeah. And even before this level, I see a lot of things within this consolidation here. First, this bar is something that you start to see before choppy periods, and we've got a lot of downside reversals, gap downs, which I know you focus a lot on. So even before this rally, there were warning signs in this area where we were going through a corrective process already, and then we just saw this rally up to highs into a potential key resistance level and saw the decline further. Is there anything else in this area where you were especially paying attention to? I know these gap downs also hit a lot of the leading issues, the AI, the energy names, the data center type names, and those have been the names that were leading. And of course, there's going to be always cycles where leaders turn into laggards and back and forth. So anything else in particular during this
Yeah, it's
area that,
interesting
yeah,
because I'm a 100% technician,
yeah,
but we do look at all indicators, and when something stands out, I wouldn't fly by that alone. But the fact that I had all of these negative signals, then when you looked at the Dow's price dividend ratio, and that moved up in that period to the highest since 2000, I think it was the spring of 2001, showed the most overvalued market. So synergistically, it all fit together. The tremendous speculation, the valuation, the fact that everybody was just concentrating on the Magnificent Seven while so many other stocks were screwing up. It was classic. And like I always say, the game doesn't change. They just change the costumes and the faces.
yeah, perfect. And I know you also want to mention maybe the Dow's price to dividend ratio, how that had moved up and how that compared to 1973. Is there anything else you want to elaborate on there?
Now, I would think those really are the main things. Oh, I guess also I should put in our surveys. All of these things fit together, Rich, like a
Yeah,
jigsaw puzzle. You had my S&P and secondary proprietary surveys. When things are really good and it's not a phony rally, you get to 70% or higher. The fact that we went up to that point that you have on the chart there, and we had trouble getting above the neutral 50% level, that again was another bell ringer that happened also in January of 2022 as that bear market was starting. So really, it's check, check, check. And this is what you have to learn. People, I'm not, again, I don't want to oversimplify and say, oh, it's obvious, but they really make the game so much harder than it has to be because they start getting into the politics and what Powell says and all this minute by minute news, which just make little ripples in the water, but that's not the main tide. When you learn to look at what's really the big tide, the game becomes so much easier.
perfect. And once this correction really accelerated down quickly, broke the 50-day, fell to the 150-day, broke below that and the 200-day moving average, what are you waiting for or watching for in order to determine, hey, there might be a tradable bounce? I know you ultimately identify the potential for one on March 13th, but what are you potentially waiting for to make sure for active traders they might be ready to participate, and for investors on any bounces, sell any stocks that they hadn't already sold, to take advantage of that increase, temporary increase in pricing.
Right. Well, okay. Now, again, the same way we looked at the long-term indicators, now we look at the shorter term, which are a little more difficult because obviously the shorter you play, the more chance you get whipsawed. But at that point, the investor's intelligence overbought oversold oscillator, which is just simply the percentage of stocks above their 10-week moving averages, had dropped down to a very low level in the low 20s. I think it was like 22% plus or minus. So that was the lowest in quite a while. In addition, a lot of our indicators, the stochastics, the MACDs, have become ridiculously oversold. But what people have to learn, oversold is only a potential.
Right.
It's kind of like gas filling up in a room, but to really get an explosion, you need somebody to light a match. So the match is once you say, okay, I'm in this area, I didn't know which exact day it was going to start, but I knew the potential was there. And then as soon as you got reversal action in the market, move sharply up on that day, you could say like, okay, the probabilities are very strong that a match has just been lit. And happily, we were right for 2 weeks. And I think that the ABC rally that we look for, I think the C wave ended this morning.
Yeah, and talk me through this 495 level, and the importance of the 200-day moving average. Those are clear targets that you've talked about in GTA. Why was that so significant for you, this area right here?
Well, just the fact that, and it still amazes me, Rich, after all these years, and you always have a great interview with me because you bring the good stuff out. It amazes me how often, from a shorter term point of view, the 50-day moving averages proved to be failures, which happened exactly today on my glamour average. It rallied up sharply. It failed within an inch of the 50-day MA. And from a longer term point of view, how often good rallies fail on a longer term basis as they pull back toward their 200-day MAs. And another thing I had pointed out at the time, you can see here the 200-day moving average was still edging its way higher when it broke. So
Mhm.
historically, and again, these are only little tricks you learn over the years. There's no guarantees they can always work, but usually there's at least one more test coming back up to the 200-day MA when the moving average is rising, which again, it fulfilled that deal right here today or yesterday. And now it's starting to flatten out. So a sell-off from here becomes a little bit more concerning.
And do you think these lows might be tested? What would be kind of your expectation of what could possibly happen over the course of the next few days, next few weeks?
Okay, again, I'm on record, so if I'm wrong, it'll be obvious. Short term, long term. Short term, I said the ABC, and happily we caught it right at the start. We caught it today at the end. But I said, rightly or wrongly, that I do not think that the first sell off after the C upwave would initially break below that March 13th low. Obviously, if it goes below it, all bets are off. I think, but I also, you read me, I've also been saying I'm not talking forever. So short term, long term, I do expect it to break, and that'll lead to another sharp down leg. But short term, my gut is that it's not going to break the first time down because we had a pretty good rally, and you had been that oversold. So I think, which I had written, that I thought it would be range bound now, and you'd probably come back and test it, but not break it. And at the minimum, I'd look for something, take a look in the area. It's about 460, 465 area. I'm sorry, I'm wrong. 470, 475 area on the Qs. I think that's where the minimum it should come to. And this is another little trick you learn. Let's say it does hold this first time down, and I'm right. The further it comes on this first sell-off after the rally to the 200-day, the sooner you'll eventually break. So if I turn out to be right and it only comes into, let's say, like 470, 472, I think that it'll screw around for a while and it won't break as quickly, even though ultimately I think it'll break. If, however, let's say it comes down with a whoosh and it right away tests that low at 466, and even if it bounces off it, the fact that it needed to come down and test that support so quickly, that would tell me that, oh, after the bounce, it's going to break sooner. So my gut, it doesn't break the first time. I think it's going to fool around and whip people in this zone. But ultimately, I do think down the road it will break.
Perfect. And I know we want to talk about some individual stocks as well, Stan. But before we actually get into the list, you talked about one thing I was noticing in this area as well that put me on guard is if we look at one of the leading growth names, PLTR, which was going, almost parabolic, you had a gap up and go. It broke lower on February 19th, which is the same day that you put out here about being negative. And this was before the overall market turned around. So that's one thing that I'm always on guard on. The existing leadership, when they start breaking lower, big drops on volume, breaking below key levels, breaking down after very strong up moves. That's something that I always take into account and say, hey, just be a little bit more defensive here, be ready, because that is a matter of weakness, especially a stock that has been so strong for the past 2 years, part of a leading theme, AI software. So that's one thing I noticed. Let's dive now into the
Wait,
names.
stop. Let me
Yeah,
interrupt you.
sure.
You're spot on and you're terrific. In the same way, now that was a warning, you're right, but let's look at what I think was an even, and that, don't get me wrong, is very important warning, but even more important, can you put up Nvidia?
Yep, there we are. Do you want me to zoom out a little bit?
Yeah, that's great. That's fine.
Yep.
That perfect. That's good. So let's take a look. Look at how Nvidia topped out and made its high in early January, which was even before that mid-February top in the Qs, which I think it was February 19th, whatever it was.
Yeah.
That's important when a leading stock like that tops out. Now, show everybody I had a series of descending peaks, 1, 2, 3, each one lower. And meanwhile, the news was great and everything is wonderful. That's another clear-cut warning. And then also look at that downside big gap that happened off of that second top. And when you rallied up, look how it just came in and closed the gap, the prior gap there, and then started to fall away very quickly. This, to me, was another bell ringer because it isn't just, any old stock. This was going to lead the market up forever. I remember, just like with Polaroid, Avon, Xerox back in 73. And when they start to crack, that's another important early warning. And now still there are people who come to me and say, okay, Nvidia, you were right about, I didn't get the top tick. We got it darn close to the high there. It's down a lot. Can you buy it now? And I go, no way, Jose. Take a look at it. The moving averages, the 200-day moving average is first starting to flatten out. The stock is still really, if you look at it on a longer term basis, I would stay stage 3B. That's stage 3 is the top and B is late in the top. So it's still in stage 3B. And if you break down and close, if I'm going by memory, I think it was like 104, whatever that low was. Take a look what that low, that one. What was the low exactly there? I think it was about 104.
104.77 exactly.
Good. Okay. So anyway, closing below, let's use the round number of 104. It's going to really hit the fan. So bottom line, this is important. And this is why, again, I think that so many professionals and other traders, investors make the game so hard. I've said this so many times over the years. It's really like playing blackjack. People get annoyed, especially those who got, their MBAs from Harvard and whatever, or from Wharton. To me, when you're playing blackjack and you've got 11 and the dealer's got 6, you don't think about it. The probability is very strong that you double down. You may lose that hand. If you keep doing it, you're going to win big over time. It's the same thing with pattern recognition. And here's where the book that we put out, I think, is so helpful. When people learn pattern recognition and see it repeats over and over again, both favorable patterns and unfavorable patterns, the game becomes so much more obvious. And this is why you have to blot out all of the news that you hear, all of the worries from Washington, and just focus on the charts. And that's why when I used to put out the professional tape reader, which I retired, I can't believe it, it's 25 years ago in 2000, at the top of each issue, it said, the tape tells all. And that wasn't just a cute phrase. I really 100% believe that's the key to the market.
Exactly. And one other thing I want to point out with Nvidia, as you mentioned, all these downside reversals, we actually had talked about in prior podcasts, these bars here, which also led to basing patterns, choppiness, all of this. And like you've said, classic kind of stage 3 action, getting choppier, wider and looser. gaps, downs, moving averages, losing momentum. What for you, and maybe it's a break of 104 as you mentioned, would that really start the stage for declining phase here if it broke
Yes.
this low? Yeah.
Affirmative, definitely. And again, you summed it up so well. Look at that. This is another pattern recognition that people have to learn. When you have that kind of choppy action, it happens as tops are forming and bottoms are forming. And after the tremendous run up we had at Nvidia and the Qs, we obviously weren't at a bottom. So again, it becomes rather obvious the probabilities.
Yep, and I'm just going to show quickly the weekly chart version here. So this is where the stage two really got underway. This is the prior stage four in the 2022 bear market. We had a continuation buy point here, which led to a fantastic rally. And then here's the action we've been talking about, wider and looser downside reversal bars. Even on the weekly chart, you can see the falls from highs here. And then here we are now below. This is the 40-week moving average, and this is the 10-week moving average. And I know currently in these faster markets, you put more weight where traders should be much more aggressive in selling, and even investors should do some selling when we break below these 10-week moving averages. It's been below the 10-week pretty much off and on since this period right here, even in middle of December, and very, very choppy since then, and now below both those moving averages. So
And this is great, Rich, and this is why I'm
yeah,
not just blowing smoke at you. I do very few interviews anymore, but I love doing with you because we so see the world through the same perspective. And I love that you put up this long-term chart. Again, I use the word perspective so often. Get a feeling. Well, it's not perfect. Look at that stage one base. Show the people how it formed there, the reverse head and shoulder, and you moved above the long-term moving average. It was classic and it was great. And look how long you had that beautiful ride up. Everything was above that whole time, above the long-term moving average. It was great, but you started going into early, what I call stage 3A, which is early topping stage three. When you rightly pointed out, when you look at this chart, again, using that word, quote unquote, perspective, look at what it looks like. It looks like, are you kidding me? Not only are we identifying a top, but if we close below that 104, which I think is eventually going to happen, it looks like gangbusters below. Look out below, and you're not going to come all the way down. But if you even make a 50% retracement of that wonderful move, a lot of people are going to get hurt big time.
perfect. All right, Stan, do you want to keep on going with the negative charts with
I'm sorry,
AVGO?
you broke up with what?
Do you want to keep going with the negative charts? We've got
Yeah, let's do
AVGO
some more
next.
negatives first, since it's so timely. Another one we just put out a sell on, put up AVGO.
Yep, here we are.
Again, can't be more timely. As of Wednesday, look, even though first show everybody when it broke the 50-day, this is why I've so sped up the process. When I originally wrote my book, I said, yeah, you do a little reducing, breaking below the 50-day or the 10-week moving average. Now I'm much more neurotic because things are so fast. I miss the specialists, etc., the old days. Now it's like press a button and boom, 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 instant fills, and everything is, so fast and wild. So when it breaks the 50-day MA, I don't wait around. I'd rather get whipsawed and come back to fight another day. But you see how early it warned us when it broke the 50-day MA after the downside gap. Show them the downside gap there. Again, look how not coincidentally it came up and tried to fill that gap. And you know what? It didn't fill the entire gap. And that's another trick to learn. People think that every gap has to be filled. Approximately 85–90% of gaps do get filled, but the ones that don't get filled are really the most powerful moves thereafter. Most people don't know, going way back when I was a teenager, off of 1962 bottom, there was a gap there after the Cuban Missile Crisis. I think it was back about like 560, 570. That was never covered, and we know what happened on the upside thereafter. But anyway, the fact that this gap was never filled, very negative. Then that's A. Then B, the fact that you broke the 50-day, bad. then pattern recognition C. Today you broke the 200-day, and we increased the short position for those that were already short. So I think that it's obvious. Again, I could look silly, but my thing isn't to hedge. I always try to deliver what I think are the good probabilities. If things are neutral and you can't talk, I just say, fine, wait until it becomes a strong call. But I read so many other competitive letters where I kid around with my wife, reader. I say, you know what? No matter what happens, they're going to be right because they've covered everything 6 ways to Sunday. And my thing, I always say, I'm just going to lay out when I see it what the good probabilities are, just like I saw that bottom on March 13th, and I saw what I think is a top today. And I think all these charts were showing them synergistically fit in with my feeling.
And certainly AVGO, Nvidia, which you already covered, they're all part of the semiconductor theme, which in of itself, you can see the choppiness, the break below the moving averages here, and now after this rally, reconfirming down big time today. So again, you're all about themes, groups, sectors all together. That just adds probabilities to what we're trying to do as traders.
Yeah, let's show them one more in this area. Put up Tom, Steve, Mary.
Yep, here's TSM.
And they're all cousins of each other. Look at how it went from the penthouse to the outhouse with that gap. Look at how it failed when it had the sharp rally to cover the gap. Look at how it then again broke the 50-day MA. Now look how you then broke the 200. Now look at how the rally as of 3 days ago didn't even quite get back to the 200. Now, understand that every day there's people buying this stock, and I just think this is like getting to buy it. Anything can happen, but this, again, coming back to my blackjack, is like getting hit on 20 in blackjack. Why would you want to buy this? I don't care how good the fundamentals are. You may pull an ace on a 20 and that particular hand hit, but if you keep doing that, you're going to go bankrupt. Same thing in the market.
Perfect. All right, next up we've got BLOK, block.
Yeah, now we get asked a lot about the crypto, and we had a real nice play for quite a while in the crypto deal. But first, the crypto itself, I think, made a major high back at 100,009. So that was one thing. Let's see, do we have that? Yeah.
Yeah, this is
So
IBIT. This is the IBIT ETF.
same things, right?
Yeah.
So you see it made that major high. And again, we've got the same whippy pattern since then. It broke the 50-day downside gap, couldn't even quite cover the gap. And I sure wouldn't want to be in this right now. And the same way, block is part of that group. So we had been long and we got rid of it when it broke the 50-day. And now look, it broke the 200-day MA. Again, it isn't as hard as people make the game to be. And I do think it's a game, but you have to learn first to be totally objective. You have to learn to put your emotions on the side and to really I don't want to be mystical, but like let the charts talk to you instead of deciding, oh, I think this is going to happen, that's going to happen. At any point, just look, what are the probabilities? And if you don't have a strong probability, just go on to the next chart.
Exactly. All right, here's the next one. We've got ESGV.
And look at it again, one after the other. It topped, it broke the 50-day, it broke the 200. The rally failed, in this case on Tuesday, an inch below the 200, which was still rising, so it may have one more shot up there. But look how many stocks, and this is why, again, I think the probability is so strong. Look at how many stocks that had got themselves in serious trouble, but just temporarily got oversold there on the March 13th, had the good reflex rally, and now it's done. They're done.
And by the way, this that little tidbit golden nugget about the rising 200-day, that's one thing I've learned specifically from just this video. So thank you so much for that, Stan. All right, we've got the next one, GBX.
Right, here we go. This one, again, one after the other. It was great, went from the penthouse to the outhouse, had the downside gap, This one just failed at the gap. Then look, it had another gap there. And that's bad when you start to get a series of gaps. Bad. And now it had this one. Now, this could even be worse longer term because couldn't even get a good oversold rally. Instead, it tried what I think anemically to make a base. And now I think it's going to fail. And if it breaks below, let's get that prior low there. Yeah, exactly. See, what exactly is that low, Rich?
52.86.
Fine. So let's round it off, 5280. You close below 5280, I think it's pretty obvious what the probabilities are here. And the fact that it couldn't even, when it got such a hit and it couldn't even get a bounce back toward the 200, it's sick. And this is what amazes me as we go through charts every night. There are people in there buying all of these six stocks, and then they'll come at the end of the day when they have a bad year and say, I'm just unlucky. No, they're not unlucky. They're not playing the game right.
All right, here's the next one. We've got GVA.
Look at, again, same song, different verse. You have a series of lower peaks, 1, 2, 3. You broke the 50-day, and then it stayed below the 50-day the whole way down. You broke the 200. Boom. Look at how it failed. And like I say, I'm like a little kid because it still amazes me after all these years of following the tape and charts, how well the textbook still works. Look at how it failed in textbook fashion exactly this morning at the 200-day MA.
Excellent. All right, next up we've got Autodesk ADSK.
Another one, and this is why I get a really bad feeling here. Remember, we're talking, this has been another part of my deal where I say, okay, it's not an A to Z bear market. We kid around and said it's more like A to S. But anyway, there is still, we'll show them in a minute, some charts that are okay, but it's not in the aggressive area. The biggest part of the rally over the prior year was a lot of aggressive growth, tech, etc. And that's where the profits were taken, and that's where the damage has been done. So this is an area of the aggressive growth that I don't want to be in for sure, while at the same time I can bury money when people say, fine, I got to be somewhere. We've got a lot of gold stocks that continue to work. They're just extended near term and should be bought again on pullbacks. We have some China, Hong Kong that looks good, some oil stocks that look okay, and some small biotech, mid-tech biotech that look okay. But in general, you do not want to be in this go-go stuff. This is what's getting creamed.
Yep. And then last one, we've got Race.
Okay, this is very interesting. Take a look. This chart truly, again, you had to be, this is why I keep telling even my hotshot, professionals, you've got to be at the top of your game here. This is as tricky a market as I've played in my many years. That's a lot of years. So anyway, look how when it made that, you got that good line on there, it broke out to a new high. Okay, fine. Now suddenly, after that, look at that sharp down reversal action. That's scary, and that's a warning. Then again, look at the downside gap. Look at how, at best, it just covered the gap. Then look at how it's gone to heck, and it's now broken well below its 200-day MA. This looks to me like it's going to, obviously, short term, it could have a rally, but on a rally, back trying to cover this latest gap, I think that this is another good short potential. Just don't do it tomorrow morning. But as it comes in and tries to cover that latest gap, I think that would be a good area to short it.
Excellent. All right, so focusing more on kind of the positive names here. First up, we've got GENI, Genius
Right.
Sports.
Right. And take a look. Here's a good looking chart. And this is why, and this is what our job is. I do think that why you can still run your money as if it's a hedge fund, your own private hedge fund. At this point, I would say obviously have more shorts than longs, but there are some good longs. I don't want everything to be monolithic A to Z bearish. So this has been one of our stocks that we've recommended several times. And I like that it recently blew out of its latest base pattern. It's now extended. It's going to come in. I'm guessing 9.5, 10-ish as it comes in. And this is the other thing. It's my old Jewish neurotic nature. I always thought that if I'm wrong, and I get you in at 9.5, I'm not going to kill you. So it'll go to 8.5. Big deal. If I'm right, I think this could be tremendous. Can we get a 5-year weekly chart up of this?
Yep. Here we go. There we go.
To take a look. I think this has tremendous upside potential. So everything to me is risk reward. And you say, okay, if I can get in near 9.5, we're going to look to do 9.5, 9.75 additional buying. And even if I'm wrong, so we probably lose a point. If I'm right, I think this stock has the potential to be an $18, $20 number. And also look at how on the latest breakout, the volume came in so nicely. So take a look and see, this versus the negative stocks we went through.
Exactly. All right. Next up, we've got EYEI, and here's a weekly, and let's go to a daily. If you want,
This is another one that's in stage one. It's actually a stage 1B, and I think that it has very little downside. So you can do, not for trading, but investing, early preparatory buying as it pulls back into the 12-12.5 area. And then down the road, if we close above, I remember this well because I've said it so many times, if it closes above 13.85, that'll signal stage 2A, early in the stage 2, and then you buy it even harder. And I could see the stock again. Can we put up a 5-year weekly chart?
yep, here we go.
And just again, to use that word perspective, let's look at that perspective. If it works, this could easily be a $20 number. If we're wrong, I think your risk is probably 11, 12. It's not going to destroy you. So this is what the game is all about. We always measure risk versus reward. And this is also why I think in that book that we just put out, which is again the pattern recognition, and I always kid around and say it's kind of like when you're first learning to play tennis and somebody hits tennis balls to you. It's a forehand, the backhand, boom. You get repetitive. You repetitively do it. You just always have to look and see what is the risk reward of a given stock, and the risk reward here is very positive. You have very little risk, and if it works, you have a lot of reward.
All right, next up, Stan, we've got AGL.
Okay,
It's
here
a
we
weekly
go
chart.
again. Here we go again. It's not as dynamic as some of the others, but it's still people are having trouble finding anything that looks bullish here. So closing above 4.70, I think this stock could have a bit of a move, and it just recently broke above its 200-day MA. So I think the risk is pretty small. And even though I like the other ones better, I think the main point is there are definitely needles in the haystack that if we do our work properly, we can find even in a bearish long-term market.
Yep, and just to show everybody, here's what the daily chart looks like. You've got a nice rounded bottom here, and this is it breaking above the 200-day moving average. Almost the inverse of the negative charts we touched on prior.
Stop right there. You've got it. That's so important. Again, this is what we're trying to do here to hopefully make people money, but also to hit tennis balls at them. After a while, when you're playing tennis, once you've got to a certain level, you don't stop to think, oh, is it a forehand? Is it a backhand? It becomes a reflexive. And it's the same thing if you really learn, which I think that book can help them do. If you learn your pattern recognition between the book and what we're doing today, it becomes so obvious. That's a bullish chart. That's a bearish chart. Forget what the news is. It just becomes like somebody is screaming in your ear.
Perfect. And by the way, is this a good 4B minus example? We've got a break above the 50 after it's been destroyed. You've got a clear level here at about what is that, 2.3 or so. Some nice volume coming in. How would you describe this setup here?
You just described it perfectly. Come here this weekend. I'm tired. Help me write the update. The bottom line is that yes, and look how the volume started to come in. It had made that double bottom, and it was a good trading call,
Right.
moving above the 50-day MA, and now it's starting to go and migrate even to longer term. But that's really the main thing. If we do one thing today, and somebody can take away and say, I'm going to learn to see what's a stage 1 and 2 and only buy healthy stocks, especially in good groups, and what's a 3 and 4. And there's no way, I don't care what my broker or anybody tells me, I'm not buying those 3s and 4s. The game becomes so much easier and a whole lot more profitable, and you don't end up reaching for the Maylocks.
Exactly. And by the way, we first talked about the 4B minus setup with Netflix way back here when it was about 160 or so, and since then obviously it started a stage 2 uptrend and now is all the way up here. So this is the power of the 4B minus. Obviously, it's more of a trading setup, but it's the start and can transition over to a strong stage 2, like we saw with this name here.
100%. Again, you're so great. And put up a daily chart because this is still one that's okay. But let's even look at this Netflix shorter term. Put up just a 1 year daily.
Yeah, so this is daily chart, and then here we go.
Right.
It's
So
about a
now
week. Yeah.
this will be another arrow, in your quiver there. The bottom line is when this one screws up, because it's still not bearish like Nvidia, it's really the market's gonna have a problem. I think that it's in the process of making like the Hunchback of Notre Dame, a head and shoulder weird top there. And when it breaks down, clearly again below the 50-day, and then down the road below that last important bottom, just go back to the March bottom there. Yeah, when this one finally goes, because this is still sort of okay, it's going to be like bowling pins hitting into each other. Then the market is really going to run into a problem. But there are still places, so institutions for now will hide out there while Nvidia goes to heck.
All right, next up we've got YOU.
Yeah, I wouldn't do anything yet, but it's interesting if forming a base pattern, and if it can go topside, and only if it goes topside, and closes cleanly above 28, which would move it above the longer term moving average there, then I think something interesting could happen, especially the fact that it has that gap that it could then run toward. So this is something from a trading point of view that's worth keeping an eye on if it breaks out. But again, whereas something like GENI or EYE, I could buy some of that coming in. I would not do any buying in this stock unless it went topside.
Gotcha. All right, the last one we've got FINV here.
A good Chinese Hong Kong stock. We put this out. It's been great. Now it's extended, so we trimmed it. But I think coming back in, the 8.5 should be the lowest if I'm right. 8.5, 9-ish coming in. I think that could again be good, and to also show them how it broke out on tremendous volume. But look, as it's correcting, how the volume is contracting.
Yep, and this is the 20-day moving average of volume for everybody watching, and we're decidedly below that moving average. Where here's the nice big volume on this powerful move higher.
Absolutely, I think that's terrific. And talking about contracting, just things always pop in my head. Another reason to be concerned about the market. First, the new lows. It's been 25 consecutive days that there have been more new 52-week lows than new highs over the counter. So that's bad. But short term, one of the reasons we had expected the rally, which I think ended this morning, was that there has been a contraction from the largest level of new lows. It was like 688, if I remember correctly, back in early March over the counter. And recently, you've been running about 200 plus. So it's bad, don't get me wrong. But it's a subtlety that it has contracted somewhat, which is another reason why initially I don't think we're going to initially break below the March 13th low yet.
Great. And just to bring up some of the charts, were there any kind of minors that come to mind, the ones that you've recommended or been watching closely, just to show those charts and how strong they've been relative to everything else?
I can't even think offhand. Let me just think a second because there have been a lot of
The,
terrific moves.
yeah,
Let me
there's NEM,
yeah, yeah, yeah.
AM, yeah.
Yeah, right. Let's look at a couple. I'm looking at my screen that have done well. First of all, take a look. One of our biggest winners, I guess, was Baba.
Yep, the Chinese theme.
Right. So put up the Baba, and
Yep,
you
here
see,
we
even
are.
though we've done profit taking in it, um, because it got temporarily extended, that's been a big winner. And there have been a lot of other ones in that area. We had also I think I'm going by memory. TC, is it TCHEY or TC? Hold on. Let me take a look. I know it's, yeah, TCEHY. Tom, Charlie, Eddie, Harry, Yellow.
I don't know if he is that on the U.S. exchange?
No, it's traded, yeah.
TC. Sorry, we
Tom,
might not be able to bring that up.
Oh, okay, whatever. Don't worry about it. But
Yeah.
anyway, there've been some good stuff there. But I think, and another one that comes to mind, oh yeah, the Berkshire Hathaway put up that's another good one we've had. Put up BRKB.
There we go.
That's been showing tremendous relative strength.
And we're in a strong growth market when Berkshire Hathaway is showing relative strength.
Right, exactly. And
Yeah.
we got to give him credit. He bought a lot of T-bills,
Yep.
you know. But so there's been some good stuff in some of our gold stocks. Like put up Apple Eddie Mary, that's been a big one, and put up AEM,
Yep.
but it's extended near term, so I'd only buy a correction here. But the really big winners have been some of the shorts. I mean, some of them have just blown up 40, 50% down. It's been incredible.
Perfect. So taking a step back, Stan, given everything that's happening in the market and all the action, what would kind of be your thoughts around if you're an active trader, what would be kind of the best use of time and focus? Is it to be, doing a mix of longs and shorts, being mostly in cash, waiting for, follow through to the downside? What would be kind of your thoughts for short-term active traders?
I think that you just gave a couple of good scenarios, Rich. I think it depends on the person. If they're a little bit more of intermediate trading, I think that you'd be running as a hedge fund with a couple of judicious longs, and at the right time, like now, laying out some shorts and more shorts than longs. If they're strictly a short-term trader, then, and I have some of them as clients, then because I know that they'd be very upset if it goes against them for a week or two. Then it's a matter of, hey, you play when you had the big down move on the short side. Then after you made that good March 13th bottom, you don't fool around. You take your profits. You do some longs. You don't go crazy, but you do some longs, which happily turned out well. And now, if they're short-term trading, I would flip again to the short side. So there's not one answer. There's the old BS about you buy and sell to the sleeping level. Each person is different, and they have to do what sort of works for them.
Excellent. Yeah, I'll stop sharing screen here. And just to wrap it up, Stan, again, we just released, of course, the stage analysis model book, which runs through even more tennis balls that you can hit with Stan's personal notes and commentary. I've only started reading through everything and I'm really enjoying it so far. There's a lot of great stocks in there, great winners from last year. GEV, I know, is one that many of you guys have probably traded and is a great example in there. Stan, how can traders best use kind of this resource? What would be kind of your recommendation to get the most out of it to
I
help
think
their
what
trading?
we've just done today, Rich, where if you just stare at the charts and if they can objectively say, I see it, it's almost like developing a feeling. I can make anybody mechanical, but if they get only certain people really develop a feel. And if you get the feel and say, yeah, I see what he's talking about. Oh, yeah, I see. The volume came in, it broke out of a base, then that's good. In the same way on the converse, which we did today with the negative charts, I think if you've done that, to me, that's getting your PhD in chart reading.
Perfect, Stan. I always enjoy chatting charts with you. You're a great educator, and I think people can really make use of the Stage Analysis Model book, which you can find via the link down below. And one more thing, as I mentioned at the very beginning, you can access Stan's thoughts every single day through GTA at TraderLion.com. We'll put the link down below. I really enjoy doing my own analysis, going through my own routines, and then taking a look at what Stan has to say. I always pick up something new, and he knows there's a ton of subtle things that you might not realize on your own. So, Stan, anything you want to mention about GTA, how it can be helpful for traders out there?
Well, I don't want to be egocentric, but I think that it's helping people who are in gear with me big time in what is one of the most challenging markets that I can remember going back the many decades I've been playing this game. So I think it can help them identify the potential blowups as well as like we did the GENI today. And I'm happy to work with anybody that's out there that would like my help.
Perfect. Well, thanks so much.
Just remember, the tape tells all.
There you go. We can end it there. Thank you guys all for tuning in. Make sure to check out the links down below and to enter the giveaway if you haven't already. Stan actually gave you the answer, so you can scroll back in time and see what he said, but you have to give your own rationale. Otherwise, you won't be eligible. So definitely go ahead and do that. And thanks so much for tuning in, and we'll see you guys in future videos. Take care.